So first, let's kind of recap and talk about what is reasonable compensation. So at its core, reasonable compensation is the salary that an S Corp shareholder employee has to take for the service they provide to the business. So this is to prevent S Corp owners from avoiding payroll taxes by taking distributions instead of a salary. And the IRS defines reasonable compensation as the value that would ordinarily be paid for like services by similar businesses under similar circumstances. So, to simplify that a bit more, what would it cost to replace yourself in the business? Or what would another company pay you for the same responsibilities? That's kind of what it means. So, it's important to be aware of this because the IRS has recently made reasonable compensation kind of a priority. Audits focusing on this have increased significantly. We've seen court cases over the past decade. And if you don't pay reasonable compensation, that can lead to payroll tax recharacterizations and penalties and interest. So the IRS can basically go back and say, hey, you should have paid payroll tax on all these distributions. So we're going to retroactively charge you for that. That would be no fun. There's lots of cases about this. There's one called the Watson case where the IRS recharacterized over $134,000 worth of distributions as wages, which resulted in almost $50,000 in additional taxes, penalties, and interest. So this stuff can be costly.